Okay, in part 3, we're now going to talk about the income approach to appraisals. As an investor, you will want to know what is going to be the income based on past results of the building which, for instance, you are thinking of buying or building yourself. As an appraiser, we have to put ourselves in the shoes of the investor. And the way we do this is by measuring the flow of income projected into the future based on what has happened in the past and based on what is happening in other similar income producing properties around us. So the market value is based on the present worth of future income. If I expect to get this amount of income out of it in the next year, I'm prepared to pay this amount, or this building will be worth this amount of value. So first of all, we have to start off with a few formulas. We have effective gross income. We start off with potential gross income. Let's just go to my next slide. We have potential gross income. Let's suppose we're talking about an apartment block with apartments in. If I was to fully rent out every single one of those apartments every month for the proper rental value, then my total income from that apartment block for the year would be my potential gross income. The thing is that never happens. There's vacancies, there's collections where people don't pay the rent and so forth. So we have to take off what our estimated vacancy losses are, but also we do add in any other income at that time from maybe covered parking fees or soda machines and laundromats and so forth. When we've taken that off our potential gross income, we have now is our effective gross income. This is what we could reasonably expect to actually receive from this building. But the building doesn't look after itself, so therefore we have to take into account the fixed expenses, things like insurance and property taxes, our variable expenses such as maintenance fees, maybe manager fees and repairs and so forth, but also reserves for replacements. We've got to put a little bit aside in our back pocket in the kitty for when that roof runs out or when the AC breaks and so forth. When we have subtracted all of those from the EGI, we get our actual net operating income which that building has managed to produce for us. We don't take into account any income taxes, company taxes or mortgage payments. That comes later. Our operating expenses are usually divided in between fixed and variable, like property taxes and hazard insurance, and maintenance, utilities, supplies, which does vary according to the amount of use and the amount of tenants we have. And reserve for replacements allow us for future replacements of building components. Here's an example here. There are 10 units in this block and they rent out for $665 per month. And the vacancy loss is estimated to be 10% of the potential gross income. So we work out what the potential gross income is 79,800. We take off the 10%, which gives us an EGI of 71,000. From that, we have to deduct our taxes, our insurance, management fees, and repairs and maintenance, and our reserves, which we put aside for a rainy day. And that gives us our net operating income of 34,830. We know that that building is going to produce us an income in our pocket of 34,830 over a period of a year. Please note though that the operating expenses does not include the depreciation or the costs of mortgage or personal expenses such as business advertising and so forth, or any income taxes, any expense that does not directly contribute to the operation of the property. That's all to do with me and the taxman at a later date. So then what we have to understand is what is our overall capitalization rate, or rate of return, return on investment. Remember that building previously made us 34,000 net operating income. And we have a little triangle that we can use to work out this percentage. The I represents income, the R represents the percentage rate of return or capitalization rate, and the V equals the value of the property. NOI, OAR value. For example, if a building cost $100,000 and my NOI was $10,000, what would be my overall capitalization rate? In that particular case, it'll be 10,000 divided by 100,000, which gives us 0.1 or 10%. If I knew that my income was 10,000 and that represented a 10% capitalization rate, what would be the value of the building? Once again, I divide the income by the capitalization rate, and that would give me 100,000. Or conversely, if I knew the building was $100,000 and I expected or was getting a 10% capitalization rate, what would be my income? Multiply those out and I'll get 10,000. You have to remember I over R times V. We also have to understand the relationship between the NOI and the OAR, rate of return, and the value. For instance, if my rate stays the same and my value goes up, then I would expect my income to go up. If the rate stayed the same and my income went down, then I would expect my value to go down, and other combinations of that. Then once again, we have found all of our three different methods. We have to then reconcile the final values. And an appraiser who used all three approaches for single-family home may give a higher percentage of sales comparison approach than the percentage they would give to the other two approaches. Sometimes they will only do two approaches, not three, because one of the approaches would not be suitable at all. Another way of actually working out a potential value or income of a property is know what the gross multiplier is. When we work with two, gross rent multiplier is when we look at the property's monthly rental income, and if we divide that into the selling price, we will come up with a multiplier. How many times does my monthly rent go into the selling price? We also may look at the yearly annual income, which comes from the rent and other sources, such as soda machines and laundromats. How many times does the total annual income go into the selling price? So first of all, we have to, under GRM, which is rental, which is monthly, estimate the gross monthly rent for a subject property. We can go and calculate a market-derived GRM by taking the sale price of various comparable properties and divided it by their monthly rents, and then we can look at the individual and average out the market area GRMs. Then when we come across our subject property and we know what rent we're getting out of that subject property, if we just multiply it by the GRM, that would give us an estimate of the value of the subject property. We also have comparative market analyses, CMA. This is something we can do on a computer very quickly using RPR or any of the programs supplied with the MLS. And basically what they do is they do use solds and currently on the market and recently expired listings. And examples of that would be Zillow, Realtor.com, which give you automated valuation models. And that's really the end of chapter 16. It's quite a complicated chapter. It needs to be gone through quite a few times and do a lot of questions to get the full understanding of it. So thank you very much for listening to Unit 16.